Imagine watching nearly 390 million shares of stock change hands in just a single afternoon, but the actual price of the market, you know, barely moves an inch.
Yeah, it sounds impossible.
Right. I mean, that is not a sleepy, quiet day on the trading floor. That is it's a brutal, invisible tug of war happening right beneath the surface.
Hmm.
And that tension is exactly what we're going to explore today.
It really challenges the way most people look at finance, I think, because we're so trained to just glance at the evening news ticker.
Just looking for the green or red arrow, yeah.
Exactly. You see green, you assume things are great. You see red, it's bad. You assume you know the whole story.
But if you actually want to know what's going on, I mean, really going on, you don't just look at the daily summary. You have to, hook the market up to a monitor and look at the heartbeat.
Right, the actual rhythm of it.
Yeah, the rhythm, the pauses, the pressure building up in the system. And that's our mission for this deep dive.
We're really looking at the raw data today to figure out not just, what the market is doing, but the actual mechanics of why it's behaving that way.
And we have a massive stack of that data in front of us. Just to set the stage for you, it is Thursday, August 13th, 2026. The time is exactly 3:50 p.m.
Right before the close.
Right. And we've got our hands on this really comprehensive stack of KSE-100 market analysis reports, technical performance data for individual companies, and these incredibly detailed 4-hour time frame technical charts.
Those 4-hour charts are where the gold is, honestly.
They really are. We are going to decode the hidden language of support, resistance, and momentum for the overarching KSE-100 index, and then look at a handful of key stocks pulling the hardest at the seams. So, okay, let's unpack this. Let's start with the macro view, the big picture.
You really have to start there. I mean, you can't understand what an individual swimmer is doing until you understand, the current of the ocean they're swimming in.
Right, so let's map out that current. On August 13th, right near the bell, the KSE 100 closed just over the 180,100 mark. Specifically, 180,104.61.
Okay.
Now, on paper, that is a minor daily dip. It dropped about 206 points, which is, just 0.1%.
Yeah, negative 0.11%. Tiny.
It had pulled back from an intraday high of around 181,433, and it ended up hovering right near a key support level of 180,390.
And, a lot of casual observers might see a 200-point drop and just think, oh, the market is losing steam. But the context completely changes that narrative.
It does, because when you zoom out, the index has this massive 52-week range. I mean, its low over the past year was 144,119, and its high was way up near 191,000.
Right. It's been a massive climb.
Yeah, so despite this tiny fractional dip today, the KSE 100 is still sitting on a one-year gain of nearly 23%.
Wow.
And it's up about 3.5% year to date.
It's had a phenomenal run. And that brings us to what those 4-hour charts in your stack are actually showing us. We're looking at a classic consolidation phase.
Yeah, let's talk about those 4-hour charts, because that is where the real story is hiding. It shows the market moving mostly sideways, and the momentum indicators reflect that perfectly. We're tracking a metric called the Stochastic RSI, which is currently sitting, the K line is at 30.806 and the D line is at 35.48. So it's in the low 30s and trending down toward the oversold zone, which is anything below 20.
And before we throw too many terms around, let's just quickly clarify what that actually means for everyone listening.
Good idea.
So the standard RSI, the relative strength index, that measures how fast the price is changing. But the stochastic RSI measures the momentum of that momentum.
Right.
It tells us where the current speed sits relative to its own historical range over a set period.
So it's basically asking, out of the recent highs and lows, where exactly are we right now?
Exactly that.
Yeah.
And reading in the low 30s that's trending downward tells us the recent buying momentum is fading. The energy is draining out of the upward push.
Which makes perfect sense when you look at the whole year. I mean, the way I picture this, it's like looking at a marathon runner pausing at a hydration station.
Okay, I like that.
Right. They've had this incredible, grueling, fantastic year-long run. They're up 23%. But right now, looking at that 4-hour chart, they've stopped running forward. They're just jogging in place, catching their breath.
Yeah, they're consolidating.
Exactly, the consolidation phase. And that downward trending stochastic RSI, that's the lactic acid building up in their muscles, they are feeling the fatigue of the run.
What's fascinating here, though, is how the trading volume completely changes the interpretation of that pause.
How so?
Well, because if volume was low, you could just say the market is asleep. The runner's taking a nap. But our sources show nearly 389 million shares trading hands while the price barely moves.
Yeah, 388,896,812 shares to be exact. On a day, the market effectively went nowhere.
Right. That's a fierce, invisible tug-of-war happening right in front of us. For every single one of those millions of shares sold, someone else had to step up and buy it.
The exact same amount.
Exactly. You have a massive group of sellers saying, we've hit the top, I'm locking in my 23% profits, and they're pulling the rope one way. And then you have an equally massive group of buyers saying, no, this dip is a bargain, we're going higher, pulling the rope the exact opposite way.
Man, the price is sideways, but the tension is immense.
It's like a coiled spring.
The energy is there. It's just, contained for now. So, since the main index is stuck in this massive standoff, let's move away from the center and look at the specific companies pulling the hardest on either end of the rope.
Yeah, the outliers are always the best place to find the real drama in a market.
And there is plenty of drama in this stack. Let's look at a company like TPL. Just visually on the chart, it is shooting straight up. It's sitting around 23.62. If I'm an average investor watching that line go vertical, human nature kicks in.
Oh, absolutely. FOMO.
Right. Fear of missing out. I see a winner and I want to jump on board. But you're looking at the underlying math here. What's the catch?
The catch is hidden in those momentum metrics we just talked about. TPL's standard RSI is at 74.10, which is, very hot. But its stochastic RSI is a staggering 95.85.
Wait, out of 100?
Out of 100, yeah.
Wow.
A stochastic RSI of nearly 96 is essentially a neon sign blinking danger. It means the stock is constantly closing at the absolute extreme peak of its recent high-low range. I mean, it is redlining.
Okay, now compare that to the complete opposite end of the spectrum. We have stocks like GTYR and PTC.
Right.
GTYR is sitting around 33.80. It's moving completely sideways, just hovering near a support level around 32.65. And its stochastic RSI is deeply, deeply oversold at 4.46.
That's incredibly low.
And PTC is in a similar boat, priced around 71 flat, stuck in a horizontal range with a stochastic RSI of just 15.
Again, very, very low momentum numbers.
So here's where I have to push back a bit, playing devil's advocate. If TPL is shooting up like a rocket, making money for everyone holding it, and GTYR is just sitting there stagnant and depressed, why should you, as a listener, care about these sluggish, oversold stocks instead of the one that's actually making people rich today?
Because chasing the rocket is, quite honestly, the most common trap in investing. Human nature is wired to chase the antelope that's already running.
Right.
But financial markets operate on a principle called mean reversion.
Meaning things eventually snap back to their average over time.
Yes, exactly. Think of a stock's price like a rubber band attached to a heavy rock. The rock is the true, underlying fundamental value of the company.
Okay, I can picture that.
TPL's price has been stretched so far upward and so fast that the rubber band is incredibly tight right now. That stochastic RSI of nearly 96 is the sound of the rubber band starting to fray. It signals a very high risk of a near-term correction.
Because everyone who wanted to buy has already bought in.
Yes. The buying frenzy has exhausted the pool of available capital. Soon, the only people left will be sellers wanting to lock in their gains, and that rubber band is going to snap back down. Buying TPL right now means your risk-to-reward ratio is heavily skewed against you. You're paying top dollar to hold a ticking time bomb, basically, yeah. But now, look at GTYR and PTC. Their rubber bands have been stretched downwards, like pushed into the dirt by relentless selling. A stochastic RSI of 4.46 for GTYR means the selling pressure has effectively exhausted itself. Everyone who wanted to panic sell has already cleared out their positions.
There's literally almost no one left to push the price down further.
Yeah, and because they're sitting near their historical support levels, prices where buyers traditionally step in to hunt for bargains, these heavily oversold conditions make them prime candidates for a technical recovery.
So they're coiled springs.
Yes, in their own right, they're waiting for a catalyst to snap back up to the mean. It's not about chasing the winner. It's about calculating where the risk is the lowest.
That makes perfect sense. You buy when the rubber band is stretched down to the floor, not when it's stretched up to the ceiling and about to break in your face.
Exactly.
So if TPL is the rocket ship and GTYR is the bargain bin, there's a third category that's arguably the most stressful for an investor to watch. These are the stocks standing right on the edge of a cliff.
Ah, the crucial tests of structural support. This is where market psychology gets incredibly visible.
Yeah, and here's where it gets really interesting, especially when you zoom in on these 4-hour charts. Let's use DGKC as our primary example.
Okay.
The price is currently hovering around 216.41, But right this second, it is testing its ascending trendline support at exactly 215.47. Its momentum is dead neutral. The RSI is 54 point centi. And our sources note that if it breaks below that 215 support, it could fall fast to the next floor at 208.24.
It's teetering right on the edge of a structural breakdown.
And it's not the only one. PSO is in the exact same boat, priced at 351.75, but clinging by its fingernails to an immediate support line at 350.66. And its stochastic RSI is 23.39, so it's approaching oversold territory while desperately clinging to this line.
Yeah.
And LUCK is doing the same thing at 448.3, consolidating flat above a long-term line with a stock RSI of 15.73. It's like these massive multi-million-dollar companies are all balancing on this thin diagonal line drawn on a piece of paper. I mean, why does a line on a chart have so much power over real-world money?
Well, if we connect this to the bigger picture, it's crucial to understand what that diagonal line actually represents. An ascending trend line isn't a physical law of gravity, it's a visual map of collective human memory.
Human memory? How so?
Think about the psychology of the people trading DGKC. Every time the price dipped to that specific diagonal line in the past, buyers stepped in. They remember making a profit by buying at that level. And sellers remember feeling regret for selling too cheap at that level. Over time, that memory becomes the agreed-upon narrative of thousands of investors. Because everyone believes the support line is real, it becomes a self-fulfilling prophecy.
They act on the belief, which makes the belief reality.
Exactly. The trend line becomes the story that, DGKC is a reliably climbing stock as long as it stays above this line.
So what happens if the story breaks? Like, what happens if DGKC drops below that 215.47 mark?
That's why we call it a cliff. A break below support isn't just a minor $1 price drop, it's the sudden, violent failure of the collective narrative.
Wow.
Suddenly, all those buyers who trusted the trend line realize the story has changed. The historical memory doesn't apply anymore, confidence just evaporates, and that neutral RSI of 54 can instantly turn into panic selling, driving you down to that 208 level you mentioned.
Man, so you're basically watching thousands of investors collectively holding their breath, waiting to see if the story still holds true. It's not math at that point, it's a psychological thriller.
It really is.
Which brings us to our final group of individual stocks. We started with the dangerous, overbought rocket of TPL. Let's contrast that with stocks that are actually climbing healthily.
Right, the ones taking the stairs instead of the elevator.
Yeah, look at CNRG. The price is around 13.69. It has a steady bullish climb. Its RSI is at 65.14. Our sources describe this as healthy buying interest without being overextended, with the next resistance level up at 14.54.
That's solid.
And MLCF is doing something similar near 101.0 with a very steady RSI of 57.84.
Those are the real workhorses of a solid portfolio.
And then there's TPLP, which, just to be clear, is a completely different ticker from the TPL we mentioned earlier.
Right, don't mix those up.
Yeah, TPLP is at 1530. It's generally trending up but hitting some resistance near 15.49. Its RSI is positive at 63.04, though its short-term stochastic RSI is cooling off a bit down to 29.27.
So it's taking a breather while still maintaining its overall upward structure.
I do have a question about this, though. Earlier, we talked about TPL being highly dangerous with an RSI of 74.7. But here, C-Energy is at 65.14, and we're calling it healthy. To a layman, 65 and 74 aren't mathematically that far apart. Why is one a steady climber and the other a ticking time bomb?
Well, that's the million-dollar question for technical analysts. It comes down to velocity and the ability to breathe. Momentum needs room to breathe.
Okay.
Think of the RSI like a car's engine temperature gauge. 50 is perfectly normal operating temp. When C-Energy is at 65, the engine is running hot, but the cooling system is keeping up. It's cruising efficiently on the highway.
So what acts as the cooling system in a stock?
Sustainable trading volume and minor pullbacks. There's steady volume supporting the price of C-Energy, meaning new buyers are stepping in at a measured pace. The people who bought early are taking small profits, and new buyers are absorbing those shares without disrupting the trend.
Ah, I see.
The engine is warm, but it's not overheating.
It's a controlled burn.
Exactly. But when a stock like TPL shoots up parabolically and hits an RSI of 74, it's like someone stomped the gas pedal to the floor while in neutral. The engine is redlining. It just can't sustain that level of output without a mechanical failure. Steady volume, like what we see with CNRG and MLCF, builds a structural foundation underneath the price. Parabolic spikes build a house of cards.
So you want the tortoise, not the hare. The steady climb builds actual stairs underneath it, whereas the rocket ship leaves a massive gap of empty air beneath it if it suddenly runs out of fuel.
That's the perfect way to visualize it. And that's really why technical analysis is so valuable. It lets you look under the hood and see whether a rising price is a well-tuned engine or an imminent explosion.
Wow. So what does this all mean for you, the listener? We've zoomed out on the massive tug of war happening with the KSE-100. We've analyzed the oversold bargains waiting in the dirt, the stocks balancing on a knife edge of structural support, and the healthy climbers taking the stairs.
We've covered a lot of ground.
We have. But if you take a step back, whether you're actively trading these specific stocks or you're just someone curious about how global finance works, these technical charts aren't just dry math and decimal points.
Not at all. They're profoundly human.
They are visual representations of human emotion mapped out in 4-hour intervals. Every one of those support lines is a monument to human hesitation and confidence. Every RSI spike is a measure of pure greed, and every drop is a measure of pure fear. We're just reading the psychological footprint of millions of people making decisions with their money in real time.
This raises an important question, though, because as much as we analyze these footprints, we have to remember the limitations of the map. Technical indicators, whether it's the likelihood of GTYR bouncing back from being oversold or the high probability of TPL suffering a correction, they only point to probabilities.
Right.
They don't point to certainties.
The market doesn't actually have to obey the chart.
No, it doesn't. The market is a living thing, and it always retains the capacity to surprise us. A chart can tell you what's most likely to happen based on how humans behaved yesterday, but it can't guarantee how they'll behave tomorrow.
And that leads me to a final thought I want to leave you with today. Something to mull over. We've just spent all this time analyzing the meticulous geometry of these charts, the exact support lines, the precise RSI thresholds where a stock goes from healthy to overheated. It feels very scientific, very EKG.
It creates a strong sense of order.
But what happens to all these perfectly drawn technical rules when an unforeseen, massive, real-world news event suddenly breaks? Let's say tomorrow morning, completely out of the blue, there's a major geopolitical crisis or a sudden massive shift in global interest rates.
The kind of black swan event nobody's algorithm predicted.
Right. When that news hits the wire, do these historical trend lines still dictate the market's reaction? Will a stock like DGKC carefully stop falling at exactly 215.47 because that's what the collective memory says it should do? Or does sheer human panic completely overwrite the technicals in an instant?
That is the big question.
It's something to think about. When the heartbeat of the market goes into sudden cardiac arrest, does the EKG still matter, or do you just have to grab the paddles?
That's the ultimate tension between the chart and the real world.
So keep an eye on those charts, but keep one eye on the horizon too. We'll catch you on the next deep dive.